Microfinance industry. We have seen how the industry has grown up to $30 billion market size, and the growth has been around 8 to 9% over past year. And in terms of quarter to quarter growth, it is 10%. So the growth is there, and a lot of micro lenders are there. NBFC, non-banking financial companies, microfinance institutions are there. Uh, and banks, commercial banks are there. So all of these are driving this sector, and a lot of hope is there lying on this sector. Now, if we go back more than a decade before, then earlier MFIs, when they were launched, there were issues raised in terms of rates, uh, high interest rates charged by these lending institutions, microfinance lending institutions, and then a difficult collection system, how the harassment happened to the consumers. And later on, we see how NBFC was involved into the picture. NBFC MFIs came into the picture. And over the last 10 years, we have today around 200 micro lenders, out of which 80 to 90 are NBFC MFIs. Now, if we look into the kind of regulation which they are into, then there are to be the changes are required in that. That is the idea which comes out. NBFCs are regulated as of now in terms of the kind of interest rate they can charge to the consumer and the kind of uniformity they need to maintain while lending. And also there are limits to number of NBFCs, MFIs giving loans to a particular borrower. So these are the regulations there, among others. On the other hand, commercial banks are also operating in this, and they are operating very well, increasing their space in a way, lending to more and more borrowers, which are not regulated in terms of interest rate capping and other things. So these things lead to an understanding, and RBI has come up with a proposal to change the regulatory ecosystem in this MFI industry, seeing the size and the kind of contribution being given by different stakeholders. And this change is largely, in principle, the change in focus from the lenders to the borrowers. Now, the idea is to focus on borrowers, what is their repaying capacity, debt repaying capacity, which can be measured by their debt to income ratio. So all the borrowings they can take from all kinds of institutions, but their debt repayment capacity is to be observed, measured, and that is the basis to give them further loans or the kind of interest rate to be charged for those loans. And these interest rates need not be capped, which is as the case now. So these change in regulatory space will give a level playing field to all kinds of lenders in this ecosystem, and there will be more growth, more economic activity, more economic activity for the borrowers as well, and lesser default. And that is the idea with which RBI is coming with this proposal, and hopefully it will work wonders, what I understand. Thank you.